Well, I think here we need to disaggregate between Chinese consumers and demand in China because equally in the Richemont results, we saw that Japan was up 59%. So that's clearly not made up all by local demand. There's a huge amount of tourist demand, primarily from other Asian tourists, including Chinese tourists. So what used to happen before the pandemic is that about 70% of luxury demand by Chinese consumers was used to take place outside of mainland China. With the lockdown, with no one able to travel, that all got repatriated back to mainland China. Now that people are on the move again, that's again moving back abroad, which explains some of the strength in these other Asian destinations, which Chinese travelers are prioritizing at the moment. Japan, in particular, is of strong appeal because of the weak yen, plus the tax-free shopping, which can mean that on average prices, especially of higher priced items like these luxury goods, can be about 30% cheaper than they would be back home in China.
So don't write off the Chinese consumer. They're just being frugal here and trying to get a bargain. In terms of what you're seeing, though, at the jewelry masons versus specialist watchmakers and others, the numbers are still weak, though, and it does tell you something about luxury coming off the boil. You've got just 2% up for the jewelry masons, but down 14% for watchmakers, specialist watchmakers. How do you think these numbers from Richemont look, given there are concerns around luxury?
Yeah, I think the organic numbers is what the market will focus on, since the numbers you cited also include the effect of unfavorable currency translation. And so jewelry maisons up 4% is, I mean, that is relatively creditable in the context of what we had from, of course, Burberry yesterday, Hugo Boss today, Swatch yesterday as well. And I think the Swatch results really kind of highlighted to the market that the watch business remains quite weak. But the jewelry market up mid-single digit is slightly ahead of market expectations and points again to this normalization. You're absolutely correct. Luxury is coming off the boil, as it should have always done, given that 25% growth that we saw in 2021, 2022 was never sustainable. It halved to that last year at about 10%. I believe it will continue to have from there this year before we get back to that normalized trend growth rate of about 6 to 8%, which is what we should expect to see from these companies. And what they were valued at prior to the pandemic was for offering this very steady 6 to 8% growth at high margins and return on capital employed.
So it's fascinating listening to you and Karen speaking there as well. In terms of the port in the storm is expensive, whether it's LVMH or whether it's Hermes, which trades at even twice the valuation on a forward PE of LVMH as well. Is it worth paying those premiums for those ports in the storms, i.e. finding the best reputation, the best kind of more recession-proof companies, or actually is the price just too high?
I think if you look at valuations for those companies, well, I mean, there's kind of a bifurcation, if you will, because there's Hermes, Brunello Cucinelli, Ferrari at the very high end, trading at relatively rich multiples relative to the rest of the sector, if not necessarily their own history. And then you have companies like LVMH and Richemont, where they are seeing they're not perhaps as defensive as Hermes and Brunello Cucinelli, but they are proving their worth in this time in terms of delivering at least low to mid-single digit growth in the context of, say, brands like Gucci, brands like Burberry that are really struggling and delivering double-digit declines. And for that, you're paying a much more modest, I mean, if you look at Richemont, its valuation is sub 20 times for a company that just today announced it has over 7 billion euros of cash on its balance sheet, which is quite a meaningful proportion of its market capitalization. So I think there is a balance to be struck, but certainly what the market seems to want to avoid is those banana skins coming from brands that are exposed to that lower end, more elastic consumer who is clearly continuing to seek value in this environment.